Foster, one of the premier investor coaches of South Florida with SmartPlan Investing. We have offices in Jupiter, Florida and Atlanta, Georgia. Today I'm going to talk to you about something that most investors don't discover until it's too late. And my hope is that by sharing this information in this story with you, that I can help you to avoid this common investing pitfall. Back in around 2006, I was working in our tax department, and we had a client who came in, and what happens when you're doing taxes is you are going to report profits and losses usually, so we can see what the investor is invested in. And this investor was very heavily weighted into one stock, and that was Bankrate. Now Bankrate had a great run up. Bankrate actually is a site many people, even still to this day, will go to when they want to look at mortgage rates. So all the big banks were advertising on their site. So this client had actually invested in Bankrate when its shares were like 49 cents a share many years before, when his son started working for the company. And as the share price started to go up, he started putting more and more money into that investment until it was his primary investment. So what we did was we sat down and had a conversation about the lack of diversification and the risk that he was taking on investing in this one stock. Now, he left that meeting and unfortunately didn't heed any of our advice and decided to, take his chances, and felt that he could continue to get these superior returns over the rest of his life with this one stock. Unfortunately, just a short time later, 2007, fourth quarter, the market started taking a downturn. All through 2008 and the beginning of 2009, the stock market took significant dips. And between the loss of that portfolio and other factors, this individual lost their entire life savings. Shortly after that, lost their home, and not too much longer after that, their marriage. So I've been in this industry for over 15 years, so the claim I make, I don't make it lightly. It's from personal experience of seeing investors be devastated by this one common investing pitfall, and that is stock picking. And stock picking really is exactly what it sounds like. It's picking stocks based on a belief that it will do well in the future, or that it's going to do better than all the other stocks, or of a whole area. So you can look at the S&P 500, for example. Many people will invest in companies that fall in the S&P 500, which is your 500 largest companies based on capitalization. It just means how many shares did they have outstanding multiplied by their share price, and those 500, the largest ones will be in the 500. And those are the names that we know, trust, and love, like Apple and Amazon and Facebook, right? So it's very easy for us to pick our favorites. Ladies, it's like trying to outfit our closet with our favorite designer brands. But unfortunately, with investing, doing just that isn't really, in my opinion, the prudentest strategy. So unfortunately, I've seen many investors have destructive results because of doing stock picking. There is actually a way to invest where you can actually own those companies without stock picking and without doing any of the destructive behaviors. So if you would like more information about how you can do that for yourself, visit us online at smartplaninvesting.com, and we'd be happy to talk to you about the other destructive investor behaviors and the solution that we have to avoiding them. Thank you so much for taking the time to watch this video, and we look forward to hearing from you soon.